Goldman Sachs has had a rough couple quarters, but given the bumpy ride, I wanted to figure out, is now a good time to invest in Goldman Sachs? For those of you who aren't familiar, the Goldman Sachs Group, ticker symbol GS, is one of the largest investment banks and brokerages in the world. Its current market cap is $107.33 billion. The company just released its earnings report a couple days ago, so we're going to hop over to their most recent presentation and see what we can learn from it. All right, so on the top we can see a number of their different results. I'll let you look through those if you'd like, but I wanted to point out a couple of the highlights that I found very interesting. First is that Goldman is number one in mergers and acquisitions, equity and equity-related offerings, and common stock offerings. This comes as no surprise. That's kind of their bread and butter, but it is still just good to note that, hey, they're still number one. They're still the big dog in the game. What I also found interesting is that they had record management and other fees of $2.41 billion. They also had $2.68 trillion of assets under supervision. Obviously, we all know Goldman is a big bank, but it is a really big bank. And to see them making record fees in management and other fees this quarter is actually pretty good to see because, as we're going to see, they've had some issues elsewhere in the company. And that kind of leads into the third point, that they've announced agreements to sell GreenSky and Personal Financial Management. These are both consumer-focused parts of the company that Goldman tried to expand into because they don't typically work with the consumer side. They're more with the business side of things and with asset management. And so they attempted to go into the consumer side, and they've had a lot of issues since then. So this is essentially Goldman offloading a very large portion of their consumer business. Breaking down their financial review, we can see that in the bottom right, by net revenues, global banking remains their largest source of income. By about 2/3 of the total income comes from that, and their asset and wealth management makes up approximately the final third. They do have some small earnings from platform solutions, but those are relatively small compared to the other two major revenue streams for the company. I did want to point out that Goldman's provisions for credit losses has increased very slightly, actually, so it shouldn't be too alarming. But when a provision for credit loss increases, that means that the company is expecting more loans to potentially go bad. So anytime we see that number go up, it's usually to stay within the regulations set by the U.S. government. They're required to do that typically. But it's not generally a good sign. You'd prefer to see that go down because it would mean that Goldman has more loans on their books that are healthy. And so this is just kind of telling us that, hey, the current market environment and the current economic environment is making some of the loans a little bit more riskier over time. And due to the recent issues in commercial real estate, Goldman did add this slide where they show the amount of commercial real estate loans that they hold and their exposure to it. So for all of their loans, 14% are in the commercial real estate segment. That's not a terribly large exposure, but it is something that could theoretically have a major impact on their bottom line. Only 3.4% of those are past due, which means they're over 30 days late. So Goldman isn't being too terribly adversely affected currently. That number can get very bad very quickly, but 3.4% past due, especially in the commercial real estate segment, which has been struggling lately, is actually not too bad. And then finally, I just wanted to show off the standardized CET1 capital ratio for Goldman. It's currently at 14.8 for its standard and advanced ratios. And if you're not familiar, the CET1 is a ratio used basically to determine the health of the company and how at risk a bank's loan portfolios and business is. So the higher the number, the better. And 14.8 is actually a fairly solid number. If I go over to Statista to show off the different common equity tier 1 capital ratios for the largest banks, this is some old data, but you can see that 14% would put Goldman pretty securely towards the top as one of the safer banks. In this data set, they're actually at 9%. So they've drastically improved that number. And so that would just basically say that we can expect Goldman to be a pretty stable, pretty safe bank compared to its peers. So next I'm going to move over to a few headlines, just kind of chat about things that are going on in the company recently. So first we see this headline talking about GreenSky's sale, and it shows that Goldman's consumer lending business kind of failed and they're just trying to get rid of it. We can see back in 2021, Goldman bought GreenSky for an agreed deal worth $2.2 billion, and that acquisition actually closed for $1.7 billion. Goldman Sachs did absolutely overpay for this business though, and it's shown that they've took a $504 million impairment charge on their consumer platforms business, which includes GreenSky. The net charge-off ratio for their consumer business, grew to 5.8% for their consumer loans, which was up from 4.6% seen in the last quarter. This means that their consumer lending is getting worse and worse and that they're taking more and more losses. And so it's no surprise that the company is kind of sick of this little experiment and they want to get out of the consumer business. And finally, the most recent headline following Goldman Sachs earnings. This is from the New York Times that said, for Goldman Sachs, no bad news is good news after a brutal stretch. If we scroll down, we can see that the headline is kind of misleading because bad news to me would be not making as much money, and the bank did not make nearly as much money as it did a year ago, with their profit falling by 1/3 from a year earlier to $2.1 billion. That's 33% less than they made 1 year ago. I would consider that bad news. I'm sure you would consider it bad news if you made 33% less money versus last year. But I guess for Goldman's case, that's the least bad news, and it was generally expected by Wall Street, so I guess they get the win. What is more interesting is that there are reports that David Solomon, the CEO of Goldman Sachs, has, quote, contended with what amounts to a staff revolt. This comes from many partners at the bank who have departed and left the company or complained quietly at the company about his unyielding management style. Now, what that means, I am not entirely sure. I do know that this guy has had a moonlight job as a DJ that I'm sure a lot of people felt was kind of unnecessary given that you are the CEO of one of the world's largest banks. But if you do want to find this article, there is a link to whatever his unyielding management style is in case you're curious. And to top it off, several of Goldman Sachs' competitors have already reported their third quarter earnings, and they're off to a much smoother ride than Goldman, with Bank of America reporting a 10% rise in profits, JP Morgan reporting a whopping 35% rise, and Wells Fargo and Citigroup both beat their analyst expectations. Now, Goldman Sachs did beat its analyst expectations, but those expectations were for a 35 to 40% loss. Bank of America is making 10% more. JP Morgan's making 35% more. And Goldman Sachs they're just happy that they only lost 33%. So not a great picture for the bank, but we're going to hop into the numbers. Let's see if this bank is investable or if it's currently sitting in a really rough spot. So looking at Goldman's revenues, we can see that it's grown at about 5% per year for the last 5 years, but it definitely hit its revenue high in 2021, and it has been nowhere close since. Net interest income for the bank has risen quite steadily, and that can be partially explained by the growth in interest rates, but at the same time, interest rates in 2018 were higher than they were in 2021, so we'd have to ask ourselves, where's that extra interest coming from? It could be coming from more loans and more deposits, which would naturally increase their interest income because they have more ability to earn interest on those deposits, but that would be something for further research to figure out why net interest income has continued to rise and rise rather sharply over the last 5 years. Goldman's operating earnings per share has been basically flat since 2018, starting at $25, kind of fluctuating, having a huge spike in 2021 to $60 per share. And in the trailing 12 months, they're back to $23 per share. Their operating margin has fallen over time, but is generally stuck between 30 and 40%, with the trailing 12 months being the most depressed number. Return on assets show a more steady decline from about 1.12% to 0.5% in the trailing 12 months. For a bank, a 1% return on assets is fairly solid, but 0.5% is definitely on the lower side. What is a positive, though, is that Goldman Sachs has been buying back its shares. Their total shares outstanding have decreased by about 2.25% per year. So that is a solid trend that we should continue to look forward to and hope that they can continue to make those buybacks. Cash and cash equivalents jumped substantially from 2020 to 2021. And so that might be the main reason why their net interest income increased so quickly and so much as well is this massive increase in cash and cash equivalents. And that may have come from the Green Sky acquisition. It may have come from other acquisitions or their deal with Apple. There's a ton of different explanations. But the cash on hand at Goldman Sachs has increased quite a bit as well and is showing signs of continuing to increase. The company's annual provisions for loan losses has actually been decreasing over time. And this is good because it shows that there's less stress on the company's loan balance sheet, and the people in places they're loaning their money to are generally paying back that money and staying current with their loans. So that's always good to see as a bank. The lower the loan loss provisions, the better. Book value per share has grown by over 10% per year, but has leveled off quite a bit from 2021 to the trailing 12 months. So we have seen a bit of a slowdown in Goldman Sachs' growth. Their tangible book value shows basically the same picture, growing at a slightly slower rate of about 7%, and once again leveling off in the last couple of years. Goldman Sachs' free cash flow per share has been a little spotty. but the company is generally free cash flow positive and can afford to pay dividend as well as buy back its shares with generally very little issue. The company does pay a dividend and it has grown exceptionally fast at over 30% per year over the last 5 years. And I think part of this is to keep the stock relevant and interesting to people on Wall Street because there hasn't been much earnings return over the last few years, but with an increasing dividend and a dividend increasing as fast as it is, I think that entices a lot of people to buy and hold on to Goldman Sachs' stock. The company's payout ratio has been generally very safe, although it is getting up into the mid 40%, and that's certainly not unsafe, but it is much higher than it has been in the past. So moving over to the earnings chart, we can see that currently Goldman Sachs' PE growth has been negative over the last 5 years, and so the chart is showing a negative number. I'm going to change that to 15 because I think 15 is a generally good baseline to start at for any company that is making positive earnings but not growing at larger than 15% per year. So when I make that change, we can see that Goldman is generally undervalued on a PE basis, although it's not uncommon for financial stocks to trade at slightly lower PEs. If I change this number to 11, we can see that that mostly mirrors where Goldman Sachs' price tends to gravitate towards over the last 5 years. That does not mean that the current 13 PE is overpriced because 13 times earnings is still a pretty fair value for a company as large and as important to the global economy as Goldman Sachs is. But you may want to recognize that there is the potential that Goldman Sachs' price to earnings ratio will contract over time, which would lead to some equity losses. I just realized that I had not updated the projected CAGR of Goldman Sachs, so I apologize for that. I did correct it now. It is currently expected to be 9.1% growth for the next 5 years. I don't believe that number is reflecting their current earnings because earnings was so recent. Analysts really haven't had enough time to analyze the business. So we could see an update to their projected growth rate in the near future, but I think 9.1 is still a fair number to expect for Goldman over the next 5 years. So moving on to the next chart, this is a price to book value chart. If anybody is new to analyzing banks, this tends to be the number or the ratio that most people look at to value a bank. Price to earnings is, of course, important, but price to book value, or basically the summation of all of the loans of the business and the value of the loans, tends to be what people look at in order to judge just how fairly valued the company is or is not. So we can see in the top right that Goldman Sachs' average price to book value over the last 5 years is 1.08. And its current price to book value is 1.02. Typically, we would consider 1.00 to be a fairly priced book value. Anything over 1 would technically be considered overpriced for a bank, and anything under 1 would be underpriced for a bank. Now, that isn't exactly true because a high-performing company that continues to perform well should trade at a higher book value because they can make more money on that book, right? That would make sense. So with an average price to book value of 1.08, it kind of tells me that over the last 5 years at least, Goldman is traded as kind of an average bank. And with that in mind, we can see that since its current price to book value is 1.02, that's very close to 1.08, and we could assume that Goldman is currently sitting at a fair value, but it is not undervalued or overvalued in its current situation. So finally, let's go over what I like and don't like about the company. First and foremost, what I like is that Goldman Sachs is an investment banking giant. I mean, there's no other company that has the size and scale of Goldman, the experience of Goldman. So I think that's a major pro, and it's going to stay an important player in this space for a very long period of time. Second, Goldman Sachs is too big to fail. Let's be honest, this isn't a company that's going to just disappear. The US government and the world economy could not handle that. That doesn't mean that its stock value is going to drop significantly, but it's going to be a company in 10 or 15 years. And third, its core business will rebound in time. There's going to be more IPOs. There's going to be more assets to manage, etc. So I'm not worried about Goldman Sachs returning to profitability and reaching all-time highs in profitability in the future because inflation would make it inevitable anyways, right? And its core business, since it is such an expert, it will always garner a lot of attention and a lot of business from clients. What I don't like is that it's moderately cyclical for a bank. Banks aren't typically a super cyclical business, but because Goldman Sachs works with things like IPOs, works with client funds, these are all things that can go up and down a little bit more with economic cycles. And so it makes Goldman a far more unstable bank as far as earnings are concerned. I mean, over time, it's still making excellent earnings and it's stable over time, but those cycles can make for difficult times for Goldman, more so than what would happen to a more normal bank like JP Morgan or a Bank of America. Second is that they've really failed at diversifying their company. I don't think they necessarily need to, but they certainly tried to and wasted a lot of money doing it. And third, there might be some issues with management here. People kind of seem to be turning on the company, especially internal employees. And so when you lose talent, you lose money essentially in the banking business. So it might not be a good sign for the bank in the next few years if they continue to lose talent. And it just kind of tells me that something's wrong internally. And if something's wrong internally, that doesn't usually lead to good outcomes in the future. So those are my thoughts. For me personally, I'm not going to be buying Goldman. I think there's other businesses out there, other banks out there that offer a better reward, certainly, and might be also higher risk, but a much better reward. And so I hope you enjoyed my overview of the company. Please let me know what you think. And if you have a moment, please leave a like and subscribe to the channel. With that, guys, have a great night. Bye.